Welcome to the Energy Desk, a limited series from Mobius Risk Group on the macro and fundamental trends shaping global energy markets. If you like what you hear and you want us to keep this series going, make sure you let us know by following wherever you get your podcasts or dropping a note to amelvin@mobiusriskgroup.com. Let's hop in. Good to see you.
Good to be back on the Energy Desk, Alex. So today's topics start with just an overview. Talk a little bit about the recent Fed rate cut, some Cushing inventory levels, the good old U.S. nuclear fleet, and some thoughts on regional gas markets and regional inventory levels. So let's start in order. You'd put out some pieces earlier this week. Would like to hear your take on the recent Fed rate cut, maybe a brief history and what we think about how macro markets have behaved in response to that cut.
Yeah. So as we discussed last week on the podcast that was released on Monday, Wednesday's CPI data for August a week ago, we were looking at higher than expectations inflation, and that had an immediate reaction in the market where people were saying, okay, this is probably going to cause the Fed to move with a 25 basis point cut. And as we commented on the Wednesday recap of that data, we gave a few reasons why we expected them to move with a greater than 25 basis point cut. And this week that unfolded as we outlined, and they moved with a 50 basis point cut. And so there's a couple things that were pretty interesting about that. So it's really the third instance of the Fed starting a rate cut cycle with a 50 basis point cut since 1984. The other two times before this one, we had 2001, 2008. Both of those times we had some reactions with inflation, where inflation picked up after that big cut. And then the US subsequently fell into recessions both of those years. And we have, some factoids on that, but I'd, be curious to hear if you have any thoughts before we get into maybe some jobs, reactions and things like that. How did crude markets react?
Well, honestly, I think the crude market has had a nice little bounce off of last week's lows. And as we discussed in our daily update earlier this week, in some way there's a little bit of a cliffhanger later on Friday afternoon. This being recorded on Friday AM, likely to be released on Monday. So in the time between the recording here and when it's published, there will be some information regarding spec positioning. And in a lot of ways, I think the rate cut move can be taken a few different ways. On one hand, it's cheaper to do things, as in make more oil, so it could be seen as more supply. On the other hand, it could be seen as a positive stimulus for the economy. And we've certainly seen macro markets move higher this week, new highs for the Dow and the S&P and the NASDAQ lagging a bit, but getting within striking distance of its all-time high. And I think the crude market in a lot of ways is stuck in this in-between where it's not really sure if it's time to go higher or if there should be a pause while waiting for a myriad of factors. How does the refinery outage season in the U.S. impact domestic markets? How are global markets impacted by OPEC decision-making? So, we'll get into some crude inventory thoughts in a bit, but I would say for now, it's just a pause, wait and see. And I'll kick it back to you and maybe go back to that thought on jobs. And, is there a wait and see there on with recent revisions to jobs data and any thoughts on latest releases? We'll pass the baton or the mic back to you.
Yeah, so it's a little bit of what we're thinking about on the demand side, trying to gather some indicators for what the reaction will be for labor markets, for hiring, for layoffs, et cetera. So the kind of big complication for doing a historical analysis is that the 2024 economy it is different than, many of the years that we've had high inflation or a rate hike cycle. But one of the questions that I thought was interesting from the post-decision press conference was really just saying, okay, you expect the unemployment rate to climb to 4.4% by the end of the year and staying there. Historically, that has not happened where it's just stuck at an elevated rate like that. It continues to go higher. And so, the response from Chair Powell didn't really get into many of the details to cover that. And so one of the things that I wanted to look at, kind of question I had, was what is the rate of rates of the unemployment rate? So how quickly does that rate change heading into recession years versus non-recession years? And so
I'm going to interrupt you for a minute. I hope there's a listener who decides to follow up with you, because I love the phrase rate of rates. I'm sure somebody's scratching their head. If not, you're not listening close enough. But sorry, go ahead.
Yeah. So just to reiterate what that is, we're just looking at the year-over-year percent change in the unemployment rate. And when we did this analysis this week, we saw that every recession historically has had a pretty reliable pattern, actually totally reliable pattern. And the 2024, the latest 3 months of 2024 data has triggered those levels. And so I think it is a question because, we have a lot of inflows for immigration on the southern border. That is a confounding variable. We have new technology that's going to aid in productivity, specifically AI. That's another confounding variable. But I do think it is one to just keep in the back of the mind, where that could be a demand side headwind just to monitor and something to consider, especially with the Fed predicting 4.4% unemployment rates by the end of the year. Could be substantially revised for, say, August 4.2 unemployment rate. The 2023-2024 jobs data was revised down by 118,000. And so I think that there's a lot of risk to a lot of uncertainty really remaining in the Fed's data feed. And so it's just one to consider. But I am curious, actually, when you're talking about the crude markets, we had some stuff happening with crude inventories this week. And I think that maybe paints, another picture that's worth considering. So maybe I'd pass it back to you on that.
Thank you, Alex. Well, in some respects, the crude inventory change overall for the U.S. at minus 1.6 million barrels can look rather pedestrian, neither definitively bearish or bullish. But the one thing that we had talked about and you've actually written about in recent days was the Cushing inventory level. Let's start with Cushing. So good old Cushing, Oklahoma, or the NYMEX benchmark price point. It has been for many decades thought to be the key location, so go inventory, so go prices for domestic crude. Well, and I think in the past 5 to 7 years, a micro period compared to history of markets for sure, Cushing arguably has become archaic or somewhat irrelevant. We've talked in recent podcasts about how all incremental U.S. production is bound for export. So is Cushing still important? Well, it does tend to have an influence on pricing, and maybe not so much at absolute levels as it does curve shape. So we talked earlier about how the TI market is just on pause in the low 70s. And there's still some meaningful backwardation in front of the curve. Just look at the monthly spreads. You've got the October TI contract rolling off today at a little over 72 and November at just over 71. So we'll call it $1 spread in the front and about a 90-cent spread month 2, month 3, which, as with October rolling off today, it's probably really the key spread to reference. And sorry, a little off topic there. We'll get back to Cushing. So this relatively small storage market, for context, the most that Cushing has ever had in storage is 69 million barrels. And that's about, 7% of total US. So it's interesting where you've got a location that is a small fraction of total U.S. storage having such a theoretically outsized impact on the market. So where are we currently? We mentioned earlier that the overall U.S. crude draw was 1.3 million barrels. Well, Cushing's draw for the week was 1.98, which simple math means we built somewhere else. What that has done is it's brought Cushing inventory levels down to just under 23 million barrels, which is about the same place it was last year at this time. But historically speaking, that is very low. Last year, we got down into the high 21 million barrel range. And that was in some ways a function of the market being driven up into the 90s. So here we are this year, same level, and we're just middling and kind of hanging out in the bottom end of a 1 year range. And yes, having climbed meaningfully off of last week's lows, but in this wait and see territory. So, my view on Cushing, honestly, is directionally it's important. And meaning if we keep going down, yes, the market will stay supported. But even the slightest semblance of greater injection trajectory through the refinery outage season, which effectively begins now, the market can quickly take that as a signal that there is than we need for right now. So it's not so much the absolute inventory level, but the rate of change, or I'll use your word, the rate of rates. I like that one. So if we're going up and we're going up in a hurry here in the next 4 to 6 weeks, what seems to be this find a needle in a haystack bullish data point to hang on to can very quickly move the other way. And then just give you the present context we used earlier, how big is Cushing relative to overall U.S. storage? Well, at 22.7 million barrels, that compares to overall U.S. inventory at, where are we right now? 420 million barrels. So pretty small.
Pretty small. I guess I have two questions that are related to Cushing specifically, maybe not related to markets going forward, but that 22.7 for Cushing, is there any risk that you're running into kind of the minimum viable volumes in storage for operational purposes? Is there anything to consider there?
Oh, theoretically, yes. You can't empty these things out. They don't, no storage functions very well when it's sitting at zero. However, it goes back to the point of, to keep it operationally intact and not cause any damage, that can easily be done through physical pricing. So you pay a premium for a physical barrel to get it there, and it may not be reflected in forward markets, whether it be diffs or in the benchmark pricing. It's a relatively simple near-term solution. So it comes up often. It's like the opposite gas markets. Natural gas markets in the U.S. always are debating where ratchets are. How much do I have to get out of the ground? Or, it's been quite a while since we've seen anything in the gas market near mins. So I guess in summary, I don't think it's a critical issue. And in some respects, based on the trajectory. So we hung around the low 20 million barrel mark last year, well into the end of October before we
basically right at the beginning of November.
Yeah. So, I think really the next 4 weeks in Cushing inventory are pretty important. If we match the no change sort of level from last year in refinery outage season, that's a tailwind for the market. And if we start building, I think there's asymmetric price responses. If we hold flat, maybe the market doesn't go down, but if we go up, the market does, meaning there's probably not a further upside to be had from Cushing staying where it's at. And, we'll be the first to admit I was wrong about all things Cushing if we dip down, well below 20 million barrels. And we'll maybe have to revisit your point on what are mins.
Yeah. Yeah. And some of the figures I've read, and I don't know how much merit to give those, but around, 18, 19, basically sub 20 million barrels is a cause for concern, at least. But, it's just one to monitor. There is kind of some interesting stuff that maybe we can push to another podcast on what is affecting Cushing specifically and why it hasn't really matched last year's fill rates or some of those trends since, Canada's TMX pipeline, if those are related. But I'll leave that up to you if we want to move on or stay there.
Let's move on. So I'll stay with the beginning statement on Cushing, somewhat archaic piece of infrastructure. Is it still as relevant today as it has been in the past? And we'll move over into power markets. Saw a headline that there is a deal being executed between good old Bill Gates and his Microsoft Corporation with Constellation Energy and a long offline nuclear fired power plant in the Northeast. Would you give us the color there and any thoughts you have on what's being done?
Yeah. So kind of an extension of, I think it might have been our second podcast we were talking about, where these big tech companies are placing bets on reliable power for artificial intelligence / data centers. And we have Amazon, who did their deal with Talon in Pennsylvania for that nuclear. And then you have Meta doing some geothermal. You have xAI temporarily running some natural gas turbines. But today we have Constellation signing a deal with Microsoft, as you said, to restart the 3 Mile Island Unit 1 reactor, which is not the Unit 2 reactor associated with the 1979 meltdown. But the Unit 1 was shut down in 2019 after beginning operations in 1974. But Constellation, this deal, they said that for $1.6 billion to restart the reactor by 2028, Microsoft is going to sign a PPA for 20 years, so a power purchasing agreement with them for 20 years, and that it's an 880 megawatt reactor. And I think that really just, again, reinforces what we've been talking about over the last few podcasts in this theme. Reliability is paramount, and the data centers and big tech companies are placing their bets accordingly. What that means from a data perspective, what is the reliability of nuclear versus others? So the U.S. nuclear fleet averages 93% capacity factor, meaning that for all available hours of generation, nuclear is generating for 93% of them. Whereas something where, say, variable renewable energies, like onshore wind, for example, you have a 35% capacity factor. For solar, because you are only generating when the sun is out and you have seasonal factors to consider, you're at basically 25%. And battery systems on their own, for a 2-hour battery, you're basically at an 8.3% capacity factor, and that doubles for a 4-hour system. Some of the things that I think are pretty interesting is, the average age of the nuclear fleet in the U.S., as we discussed, is about 43 years. And we have percent of the U.S. generation capacity represented by nuclear, but in 2023 generated 19% of total electricity. So it generates it outperforms for its capacity. Whereas for variable renewable energies, wind, solar, you have basically 28% of total capacity and 21% of generation. Wind and solar specifically, you're looking at 18% of installed capacity and 12% of total generation. So they're underperforming relative to their installed capacity. And I think that really cements, it limits what data companies are going to be doing from this kind of direct purchasing agreement with power companies. It's reliability. And, I'll leave it with that, with the extension.
I think there's a very interesting thing on the reliability. One thing that doesn't get talked about much, at least in my opinion, is proximity to generation. I mean, we cover the broad themes of renewables versus things like nuclear, gas, or coal, or geothermal, as you mentioned earlier. I mean, if you go back in your time machine, this is likely never to occur again. The generation that was built was near population centers, near, industrial development. In a lot of ways, the U.S. Industrial Revolution was the build out of U.S. power infrastructure, once upon a time owned by them. I think the other part of reliability in my mind would be, if I'm buying power from a facility, meaning a wind farm or a solar farm that may be hundreds of miles away from where I am, how does that increase the risk of lines going down? I mean, there's the line loss piece, but just use it in a kind of caveman simplified approach. If I got to transport something a greater distance, doesn't that logically increase the risk that something can happen on that path that cuts my access? We've seen quite a few of the data center startups, scouring the US or maybe the globe for that matter. Where can I buy this really cheap natural gas so I can plop a combined cycle right next to a giant computer box? I think the proximity piece is interesting. Just for context, and so everybody knows where 3 Mile Island is, it is a nuclear-fired power plant in Pennsylvania along the Susquehanna River. And, most of these data centers are being built in cooler climates because those little computer boxes or big computer boxes, they get pretty darn hot. So trying to build them in northern climates. If you don't mind, I'd like to steer myself in the next direction. I'm stealing the mic. Sorry, Alex.
Go ahead.
I'll stay in Pennsylvania, and no surprise, I brought up Pennsylvania because I want to talk more about Pennsylvania. So there is clearly a great deal of gas production in the great state of Pennsylvania, which will also be in the news, I'm sure, quite a bit over the next several weeks here with a presidential election cycle and a battleground state such as Pennsylvania. The Susquehanna River has even been the focal point of one of the participants in a presidential race who has removed himself, Mr. RFK Jr., in his Water Keepers Alliance. I'm sure I'm using the wrong name. I apologize, Mr. Kennedy. So in Pennsylvania, great deal of gas production. A lot of that would point at a regional gas market for a long time known as Dominion South, or for those that haven't been in the market as long, may call it Eastern Gas South. And we stay in the world of billionaires that we all know. It changed its name when Warren Buffett bought the gas transmission system from Dominion. And so now it's Eastern Gas South. Well, I want to talk a little bit, maybe as we wrap up today, about regional gas markets and regional storage. We often pan out and take broader looks at how is the world set up? What do we see next in the realm of supply and demand? And that's where we started today with some kind of macroeconomic thoughts. But on the micro level for gas markets, the behavior of regional pricing is something we feel will remain topical for many years to come due to inadequate infrastructure. In Pennsylvania, that has often meant the inability to get MMBTUs out of that state to a downstream market. And in such instances, you can logically assume that that would lead to weak regional pricing. I can make a lot, but I can't move it out of here. And that's been the narrative and the dynamic for many, many years, and has been present even recently in that DOM South or Eastern Gas South market. And there's an interesting thing. I'm starting in this market to maybe highlight a few others. If we are, in theory, in such an oversupplied, excess inventory sort of situation after a couple of significantly mild winters, one would think as you get to the demand doldrums of fall that such prolific supply markets would have excessive downward pressure to absolutely ensure there were not any incremental MMBTUs produced. And if anything, maybe even the need to curtail some. Now, in just the past few months, we've seen the October 24 Dominion South or Eastern Gas South basis market improve by 40 cents. And that's just since early July. So that doesn't really fit with we have too much. And it's not just and I'm cherry picking a contract. You can look further out on the curve and take a similar shoulder season month, October 25. Falls are always problematic in the Northeast because of that prolific supply. But you've seen the Oct 25 contract improve by 25 cents in MMBTU. So in a lot of ways, there is this dichotomy. There's this split between East and West right now, which has been a theme for the past several years in the U.S. or North American natural gas markets. Maybe we'll cover ACO a little bit, where you've seen significant issues with deliverability in the West due to some cold weather and many periods of too much supply in the East. And yet you're seeing this dynamic where the front of these Eastern markets is going up, even in supply locations like DOM South. And it's not a change in curve shape where it's front up, back down. It's just the whole thing is floating higher. And then, you look down to the Gulf Coast, and this will definitely be for another podcast. There's a hot debate on what happens between the Waha gas market and the Houston Ship Channel market. I'll just pause for a minute as maybe a cliffhanger for a subsequent podcast. The daily market at Houston Ship Channel, with reported imminent startup of the Matterhorn pipeline, should be under significant pressure. Well, thus far, the Houston Ship Channel market has seen a similar trend to the Dominion South, where daily markets are improving. Front of the curve basis pricing is going up. Now, at Houston Ship Channel, the back is actually going down. We do not see that as a function of oversupply because of this wave of Permian production, a price at which the Houston Ship Channel facing molecule is willing to be sold. So essentially a bit of a fear factor. And that takes us to the West. Sorry, this is definitely my dissertation point of the discussion this week. Highly important in my mind. West basis. It has been an outright bloodbath, collapsing markets. And in our mind, it's about time is the, phrase I'll use. There is an incredible amount of excess inventory in the West. For context, if I take all reported storage regions west of the Continental Divide, there is 27 BCF more right now in the ground than there has been at any point in history. That would be Western Canada, the EIA's Mountain region, the EIA's Pacific region, and we're not done injecting. In fact, next week's storage number for the lower 48 appears to be tracking towards a similar result as this week's plus 58, but that will be Eastern and Gulf Coast inventory changes falling and the Western inventory change going up. And you've seen markets, and I'll go all the way downstream because my dissertation's gone a little long here. The SoCal Citygate market, Cal 25, in just the past 2 months has fallen 80 cents. And this is a market that is, priced at, tens of dollars per MMBTU over the hub. Even out as far as Cal 26, you've seen pricing fall 50 cents. So the why did I make you listen to all of this? Not even leaving a moment for one to gasp for air or you to interject a question. The path going forward, unless we start really cold in the West, which La Nina would argue for, there is still more pressure in markets that have seen winter premiums at, say, the front of the Citygate curve come off multiple dollars. And that is also another topic for a subsequent podcast. What's happening to winter premiums, which have become a really interesting theme in recent weeks, months, even years. In our view, that's not fair to say. In my view, I would put my head on the block here. The idea that all is good and well, $3.50 natural gas and these basis premiums were overdone is in some ways just a function of what we've lived through in 2 mild winters. So there could be some big surprises to come.
A couple questions on the regional sides. So could you maybe return to the Pennsylvania price dynamics and maybe expand on your thoughts on why that's happening?
It's a good question. My thesis would be that those producers that face those local markets have either A, opted to have curtailments continue for longer than the market was anticipating, meaning maybe there isn't a mid-October ramp up into withdrawal season, and or the multi-year period of relatively muted rig activity is just eating away at what's available, meaning, how many drilled but uncompleted or waiting to be turned in line wells are sitting on the shelf. The latter there would be certainly a big surprise for the market, and in contrast to what producers like EQT and Chesapeake have publicly stated. But it does have us questioning, both Haynesville and Appalachian rig activity is, pretty near 2020 lows, and with no real sign of swift recovery in rig activity in the months or even years ahead at current price levels. So, I think it makes sense. There's just not going to be as much supply as the market anticipated. And the inventory levels, the East always gets full almost by mandate. So it will, just like it always does, but it doesn't seem like we're heading off a cliff.
Yeah. And as we kind of near the CapEx planning season, is there anything that is worth commenting on, price to CapEx planning?
I don't think today. Otherwise, you'd pull my string and I'd go on for another 20 minutes. But I think that's another good one. So we'll leave as the notes from today, maybe stick in with our show notes, what to expect later. Further discussion on Waha ship channel dynamics. What do we see on CapEx from both really the gas producing community and the oil producing community? Mm-hmm. I have to wait a month or two for that one. And, I think we'll, likely continue to revisit the Cushing inventory trajectory.
Yeah. Yeah. And again, just reiterating all of these data heavy topics that we did. So the, macro side, some of the Cushing data, all that will be thrown into a deck for people to look at if they would like while listening. And with that, we will call it. It's great to chat.
You too, Alex. Thanks. Good times.
Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.